Hi, everyone. Welcome to the webinar today. My name is Alexandra Alvarado. I'm the Director of Marketing and Education here at the American Apartment Owners Association. We are thrilled to have you with us. We are going to be learning so much today about tax updates that really all landlords should know, but probably don't know. And you'd be surprised to find out that your CPAs probably also don't know many of these tactics or maybe haven't told you about them. And so that's why we brought on tax expert Jared Jex from Cost Segregation Authority. Before we get started, though, I do want to just give you guys a couple of quick notes. I am going to be sharing the PowerPoint presentation with you tomorrow by email, as well as the full recording. We will also be taking questions, and we may be staying over the hour mark to answer them. And so if you could put them in the question box, not the chat, we can keep better track of this. We have over 1,000 people registered today, so we want to make sure that we are able to keep everything nice and organized. Next thing I want to say is we are very thankful to have Jared Jex with us. He is an expert, like I mentioned, in cost segregation, currently the regional director for Cost Segregation Authority, and he's responsible for their business development and education throughout the Intermountain West. Although this information will apply to everyone nationwide, so don't worry. Jared spent 15 years of his professional career in operations and client management with Fidelity Investments, where he was ultimately responsible for building and maintaining relationships across the country and with operational oversight of retirement plan assets. In 2018, Jared transitioned his passion of helping to preserve wealth to a focus on tax saving strategies. I guess they go hand in hand. His relationship and client management experience have proven to be immediately successful in teaching the principles and benefits of cost segregation to CPAs, tax and wealth advisors, and real estate investors of all levels like you all on the call today. So thank you so much, Jared, for taking the time to speak to our group. We are really excited to see your presentation.
Thank you so much for the great introduction, Alexandra. I'm excited to be here. Good afternoon, everybody. I'm really excited to get into this and share a lot of information with you today. Hopefully this is something that you're going to find very informative and very helpful. And so there's a lot we do. Like I said, I'm with Cost Segregation Authority. I've been here for the last 4 years or so, but our company's been doing cost segregation tax studies for about 12 years. So we've been around for a long time and have a lot of experience and knowledge in this area. And then within the last probably 3 or 4 years, we've also started to do the 179D and 45L tax credits and deductions. So we'll talk about those as well. It's good to know what these things are. The energy efficiency deductions are some of the most underutilized tax credits and deductions out there. And they've been around for a long time, so it's still surprising to see how many people don't know about them, especially how many CPAs aren't aware of them or the details. We'll go through kind of what they're like today, and there's also some big changes that have come about. They're going to take place in the next couple of years with these as well as part of the Inflation Act that just passed. So these are all things that we're going to kind of get into today, review these, the 179D deductions as well as the 45L tax credits. And then once we've kind of talked about those, I'm going to take you into kind of the world of cost segregation and explain exactly how it works and how these things can benefit you. Again, this is something that really was underutilized, but has become very kind of more well-known over the last few years, and CPAs are starting to become more familiar with it and utilize it more. But it's surprising how many people and how many tax advisors out there still aren't taking full advantage of that. And so that's why we like to come out and get in front of you as building owners and apartment owners, so that you're aware of these things too, and can be having these discussions with your CPAs and tax advisors. One of the things we'll also talk about is that we will provide cost segregation benefit analysis for you at no cost if you have properties that you think might be beneficial. It's something where we're here to be a resource for you. And so we can work with you and put together a benefit analysis at no cost that would show you what the projected benefits of these tax strategies would be. And then you can take those back and review them with your tax advisors. So I'll kind of dive into this, but like Alexandra said, they'll be providing some slides of today's slides and all of our contact information. Also at the very end, there's my contact information on the last slide, and we'll have a QR code that if you're interested, you can scan and go to a website and enter in your contact information, and we'll reach out to you shortly to kind of discuss how this might benefit you more. So first off, I'll jump right into the 179D tax deduction. This is something that most people don't know about a lot. The 179D primarily applies to commercial real estate, but it can also apply to apartment buildings if they're over 3 stories. And what it is, it's an energy efficient deduction that you can take, based off of the square footage of the property. It's been around for a long time, since about 2005, and up until 2020, it was about $1.80 per square foot of a deduction. In 2021, it went up to $1.83, and for 2022, it's $1.88 per square foot. What it really is looking for is a 50% improvement in the energy cost of the building. And if there's really 3 components to it, and if all, if the combination of all those 3 components meet that 50% reduction, you get that full $1.88 for 2022. But if the building doesn't meet exactly that 50% energy reduction, we can look at qualifying it just by one of those 3 categories, which is the building envelope. So we're talking about the insulation of the properties and the envelope, the windows, also the HVAC systems and the lighting systems. So you can qualify for just a partial deduction if you meet the requirements for one of these. As far as the building envelope goes, if you can get a 10% energy requirement with the building envelope, so mainly the insulation and the windows, you would qualify for 60 cents per square foot. If you qualify for the HVAC, all you need is a 15% energy reduction there, and that would be another 60 cents per square foot. The lighting, if you've, the lighting's a lot of LED and higher energy efficient lighting, that's usually not too hard to qualify for. And if you're getting a 25% energy reduction there, again, that would be a 60 cent per square foot deduction. So I'll go through kind of a little bit of a case study. We here look at all kinds of properties from, residential, small residentials, all the way up to large medical buildings, office buildings, and things like that, even ski resorts. In this example, we've put together a medical office building that we did that had a parking garage in the back. So in this case, now the parking garage didn't necessarily count, but there was 28,000 square feet of space that met the energy requirements. And so really they got to take that 28,000 square feet times that $1.80 deduction. I think this was done in 2021. And it resulted in a $51,000 deduction that they could take on that building. The parking garage itself still qualified for a partial deduction because of the lighting that was in it. So it had high efficiency lighting. And so for that 9,700 square feet or so of the parking garage, they were able to take an additional 60 cents per square foot there. And so overall, the total deduction for the 179D was $57,000 that they were able to take. So again, it's a good deduction. That deduction would come off the cost basis of the property, but you'd be able to take all of that as a deduction against your taxes. One of the big things coming up starting next year that came about with the Inflation Reduction Act is that rather than being $1.88 per square foot like it is in 2022, it's going to go up to more of a kind of a sliding scale and range from anywhere from $2.50 to $5 per square foot. For new construction, the requirements are kind of going to need to change a little bit, but if they're going to be looking for a 25% better performance based off of the latest standards, and then if you can get up to a 50% energy requirement, then it would be up to $5 a square foot. So as I showed in the example before, there was significant deduction that could be taken, and there we're only talking about $1.88 per square foot for most of that, and 60% or 60 cents for some of it. Here, coming up next year, these are going to go up quite a bit, and the deductions can be quite a bit larger. And again, these energy reductions, typically with current building standards, aren't that hard to qualify for. And so what we typically will look at is kind of the plans and the things that you're using for insulation, windows, what HVAC systems you're using, and kind of run models on that to see if they meet those energy reduction requirements. Also part of the Inflation Reduction Act was some changes to make it a little bit easier to go back and to get these deductions on existing buildings. So not new construction, but existing buildings that have been gone back and retrofitted. You can still get up to that $2.50 to $5 sliding scale on existing buildings that have been completely redone. So some questions to think about with 179D is, do I have to amend my return for properties that were placed in service in prior years? And the answer is no. We can go back and do these studies on properties that were built new or reconstructed, anytime in the last 10 years or so. What we would do is called a 481A adjustment. We would determine what that deduction should have been, and you'll be allowed to take that in the current tax year. So you don't have to go back, you don't have to file any amended returns or anything like that. We'll catch it all up in the current tax year. Again, what type of buildings does this qualify for? This is mostly commercial, but again, it does apply to apartment buildings that are 4 stories or more. What year is going to take the 179D? Really, you can go back over 10, 15 years because this has been around for a long time. Really, depending on when the building was built or when you retrofitted the building is what we'd be looking at for the requirements for that year and what that deduction credit would be. Is it an all or nothing deduction? Like I kind of said, you don't have to meet that 50% reduction requirement on the overall building. You can actually qualify for just one of the 3 categories and still get some deduction. So it's a pretty good thing to think about. The other big energy efficiency credit is the 45L tax credit. This is specifically for residential properties. So anything from single family, multifamily up to apartment buildings, as long as the apartment building isn't more than 3 stories. And with the 45L tax credit, right now, it's actually a $2,000 per door tax credit. So if you have a multifamily or apartment buildings, that's a $2,000 per unit credit that you can take. Unlike the 179D, which is a deduction, this is actually a tax credit which will come directly off the income. And this applies for properties that were really placed in service from 2005 to December of 2021. When we first put the slide together, it actually expired at the end of 2021, but I am going to talk a little bit here in a second about some of the changes that it's been reinstated for 2022, and there are going to be some changes coming that make it a little bit even better for 2023 and going forward. This credit can be claimed retroactively for any residential apartment buildings that have been completed with open tax years. It's a little bit different than the 179D, where with 179D, we can go back as far as we want and catch that up in the current tax year. Since this is a tax credit, we can, give you that credit, but you would actually have to go back if you built some new buildings in, 2019, 8 or 20 or 21, you could still take the credit, but you would need to go back and amend the tax return for those years, but it is still available. So we do work with a lot of people and home builders and things like that weren't aware of it, and we'll do the studies and they'll go back and amend their returns and take advantage of all these tax credits. So it is something to go back and take, but you can only go back and do it for open tax years. So about 2019 is about as far as back as we can go to do those and amend the returns. So who qualifies for 45L tax credits? Typically it's what home builders, contractors, or whoever paid to build the building can take that 45L tax credit. If you bought a building and did a lot of rehab, you can also do this, take this tax credit for rehabs. It just kind of requires that you're doing a lot of things such as replacing all the insulation, the windows, the HVAC. So if you're doing a major retrofit of a property, you could look at doing 45L as well. It doesn't have to be newly constructed property. I'm going to give a little bit of a case study here to kind of give you an example of how this kind of would work and how this can add up really quick. The example we've got is an assisted living center. It had 50 qualified units. The assisted living center actually had more of about 70 units, but some of them were for memory care, and so they didn't have stoves and other appliances, and so they didn't really count as a dwelling unit. But they did have 50 units that qualified, and at $2,000 per credit, they were able to get $100,000 tax credit for the assisted living center. So obviously, when we start talking about apartment buildings where you have multiple units, these tax credits can add up very quickly. With the Inflation Reduction Act, some of the changes coming to 45L are one that they did extend it for 2022. So you can still do that for things that are built or retrofitted this year. It's still $2,000 per door. But starting in 2023, it's going to be changed a little bit. They're going to use the Energy Star standards and offer two different types of credits from $2,500 to $5,000. So if the units meet the Energy Star standards, they get a $2,500 credit per door. If they meet the zero energy ready criteria, it would actually be $5,000 per door. And so that can certainly add up, and we'd like to see that, this was reinstated and that they're actually making enhancements to it for future years, because this is something that really is underutilized, and I think they're trying to make it more aware and really let people take advantage of this to drive these energy efficiency home builds and construction. So things to think about with 45L. Can you do this on a remodel project? The answer is yes. But unlike 179D, the whole property itself has to qualify and meet the standards. So you can't just look at one specific aspect of it. So if you are remodeling, it would have to require that you've gone and put in new windows, new insulation, a new HVAC system, and those things, so that the entire energy efficiency of the building meets those requirements. Can I apply for this credit for past properties I built? Again, the answer is yes. You can go back as far as any open tax years. It would require you to amend the tax return, but you can go back and take advantage of it. Is there a maximum number of units that you can claim for the credit? And the answer there is no, there is no maximum. So you can take this for as many units as you've got that qualify for the deduction. I'm going to jump into cost segregation now, which is our primary business and what we really specialize in. And I'm hoping a lot of you have heard of it by now. Like I said earlier, it's really started to become a lot more well-known over the last 3 or 4 years, ever since the Tax Cut and Jobs Act back at the end of 2017. But really, what is cost segregation and why is it important? Well, typically when you buy a property, whether it be a commercial property or residential property, it's going to be depreciated over 39 years and 27 and a half years. Really, your tax advisor is going to look at that and say, okay, you paid $1 million for it. How much was the land worth? Take that land out of it, and then whatever is left over is the depreciable basis. And that would be kind of spread out over the 39 years or 27 and a half years. With cost segregation, we actually are going to come in and do an engineering-based study that identifies a lot of the short life assets that were part of that purchase that your CPA is not going to identify and break out. And so by going in and identifying all those short life assets, we're able to accelerate the depreciation by moving a lot of the property to 5, 7, and 15 years. By moving a good percentage of that purchase to those short life categories, you're going to front load your depreciation, get a lot of tax deductions up front. Those tax deductions up front are going to help increase your cash flow and maximize your deductions, allowing you to take that money, reinvest it, and like you've always kind of heard, $1 today is better than $1 tomorrow, right? Why pay the IRS taxes now when you don't need to? If you can take advantage of this accelerated depreciation and reinvest that money in your business, obviously you're going to benefit from that. It also creates some other tax saving opportunities that I'll get into as well. One of them being partial asset dispositions. So as you make improvements and things to properties down the road after a cost segregation study, you can actually get some additional benefits that we'll go through. So cost segregation has been around for about, a long time, and really kind of been around for about 20 years the way it is now. And there's been a lot of case law that has determined what can be reclassified as a short life asset. And really, ultimately, it comes down to IRC Section 38 that kind of has 3 rules that determine whether or not something can be reclassified as a short life property or personal property. The first rule is if the property can be removed without damage to the structure. So if you think about a lot of things such as carpet, countertops, cabinetry within these units, those things can be easily removed. They're not going to cause any damage to the structure. And so those things can easily be reclassified. They're going to meet that test. The second determination is if the relationship between the asset and equipment or machinery is so close that it would be retired contemporaneously. So what I like to kind of use as an example for this is kind of like maybe the kitchen sink. We're able to reclassify the kitchen sink as personal property, 5-year asset. Well, all the plumbing behind that, now we can also take, because that plumbing is there to support that sink, because those two have a close relationship together. Now we can take portions of the plumbing, reclassify that as 5 years. Same thing with outlets for maybe a dryer, or electrical outlets for a dishwasher, or other appliances that are in the property. Not only would we reclassify all those appliances as 5-year assets, all the electrical behind them can be taken and reclassified as 5-year assets. So we're actually picking up some more things than you would actually expect. The third is the relationship between the asset and the nature of the business are unique. So this is, for apartments, this doesn't necessarily come into play too much, but a lot of times when we talk about gas stations, another thing that have the canopies over all the gas pumps, we could reclassify that canopy as a 5-year asset because it's really there just to protect that equipment. And so there are other things that kind of will come into play with this as well. If you have outdoor lighting in the parking lots and you have concrete pads that are there to support that lighting pole, we can take all of that and reclassify that as well. So these are kind of the 3 things that are typically used to determine what can be taken. And these came up with quite a while ago. And at this point, 20 years on, there's been so much case law that really has determined basically, everything within an apartment or a property that can be taken. And so, all that case law has kind of gone down and identified all of the individual things that we can take. And when we do a study, we kind of note the case law that goes along with that. But just to give you some examples of the property classifications that we're going to find and kind of identify, as far as the real property goes, or the building itself, the things that are typically going to stay as structural or still be depreciated over 27.5 years or 39 years are going to be the structure of the property itself, whether it be steel structure or wood timber framing, the roofs, the walls, doors, windows, HVAC, and most of the plumbing and electrical. Those would still be continued to be depreciated over 27.5 or 39 years. What we would do is identify any of the land improvement items, so anything that's been done to the land to improve it. Parking lots, curbs, gutters, storm drains, irrigation, retaining walls, any of the landscaping can be reclassified and put in a 15-year category. And then the personal property, which is 5 and 7-year property, are things like carpet, countertops, cabinetry, your window coverings. Like I told you before, we can take portions of the plumbing and electrical, any window treatments, any removable flooring. And when I say removable flooring, anything that's not really, the one thing that we can't take when it comes to flooring is basically ceramic tile. Again, this all goes back to case law. Case law at some point determined that ceramic tile is basically concreted to the floor. It's not easy to remove, and so we can't take tile. But carpets, linoleum, LVL, wood flooring, all of that, we could take the cost of those, move them to 5 years. So what we typically see when we go and evaluate properties, just kind of as a general rule, we typically find about 25 to 30% of the cost once the raw land value has been removed. We can take 25 to 30% of the cost typically and move it to these shorter life categories. So about 25 to 30% would either be 15, 7, or 5-year assets, and about 75% or so would remain as 27.5 or 39-year property. So these are kind of some of the things that we would look at and reclassify. As I mentioned before, there are some additional things with cost segregation I'm going to talk about, some additional benefits, one of them being bonus depreciation, catch-up depreciation for properties that maybe you've owned for several years. Even though you didn't do cost segregation when you first bought it, we can go back and do a catch-up study. So I'll talk about that, show you how that works. Also, a lot of people have a misconception about what happens when they sell the property and they have to pay capital gains and recapture tax. Are they just going to lose all the benefits of cost segregation when they sell the property? It's a common kind of misconception or misunderstanding. So I'll talk about that a little bit more. Also, we'll talk about partial asset dispositions. Those are really when you're going to make improvements and dispose of certain things. You can take advantage of the cost segregation study to get some additional deductions in the year you remove and dispose of things. And I'll explain how that works. The first thing I'm going to do is kind of walk you through a couple case studies so you have a better understanding of exactly how cost segregation works and how it differentiates itself from just regular straight line depreciation. So for this example, I'm going to kind of just use a kind of a retail mini strip mall that we did a study on. It had several units. It had a bike shop, a medical office on one end, and I think another little retail shop on the other. But for this example, we're going to say it was purchased for $1,325,000, and that we're going to say it was purchased in 2022, and that we're doing the tax study for 2022. Right now, I'm going to kind of exclude the bonus depreciation to show you how just cost segregation works. And then after that, I'll show you how it works once we bring in that bonus depreciation as well. So really, once we do the study, like I said, we're going to come in, visit the property, identify all of the short life assets that we can find, and then segregate them out to their appropriate asset class and depreciation life. And then we're going to kind of put together a revised kind of depreciation schedule. Here's kind of a summary of what that would look like compared to straight line depreciation. This slide can be a little bit busy, but I'll explain it here. Over on the left-hand side, we have the year kind of, again, we're starting with this being purchased in 2022. If we didn't do cost segregation study, that second column on the left there shows us the depreciation deduction that there would be each year without cost segregation. So in this scenario, with the purchase of 1.3 million, the first year there'd be a depreciation deduction of $16,987. Starting in 2023, that would go up to just under $34,000, and it would pretty much be the same until the very last year, until they've taken all of the depreciation. Now, with cost segregation, we're going to come in and break all that out and identify what is really 39-year, what's 15-year, what's 7-year, what's 5-year. And so you'll see there in the middle, the section in green, we've broken that out. In this scenario, we've actually reclassified about 31% of the depreciation basis and put that into the short life assets. And so you'll see that for the 39-year asset, if you look at the totals at the bottom, rather than being 1.3 million, now the 39-year property is only 914,000. And we've moved 251,000 to the 15-year category. We've moved 13,250 to the 7-year category. And we've moved 145,000 over to the 5-year category. And you'll see that then those amounts for each year category are then being depreciated over that number of years. That's typically how cost segregation has always worked. And you'll see that you're front loading, kind of taking more depreciation there in those first few years. So if we look back at 2022, rather than just under 17,000 the first year, with cost segregation, the total for the first year would be $55,000. So we've got an increase there the very first year of $38,000. That's a pretty big increase in depreciation deductions. And then if you look at the increase over the first 5 years, it actually the depreciation increase of 195,000. So again, we're talking pretty large accelerated depreciation in the first years. And why not save that money now rather than pay taxes on that? Now I'm going to kind of show you the same example, but talk about bonus depreciation. So bonus depreciation has been around for several years, really since the early 2000s, was really meant to be an incentive to get people to go out, buy new properties, spend money, and kind of incentivize them to stimulate the economy. There were some changes that took place in 2017 with the Tax Cut and Jobs Act. The first was that they made the bonus depreciation 100%. And then they said that it can be used on any property. It doesn't have to be newly constructed. It could be, previously used, as long as it's something that you bought after September 27th of 2017, it's going to qualify as a new property to you and be eligible for the 100% bonus depreciation. So that bonus depreciation, like I said, went to 100% at the end of 2017, and it's slated to remain at 100% through the end of 2022. So anything bought and put in service during those years will get this 100% bonus depreciation. Right now, it's scheduled to start drawing down 20% a year starting next year, and then continue drawing down 20% a year until it phases out in 2027. there has been a lot of talk within Congress and things about making changes to that. But at this point, we haven't seen anything that's actually in the works. So right now we're kind of still operating under this. I wouldn't be surprised if in 23 or 24, they do make some changes. They may make it 100% all the time. Maybe some people will look maybe to try and get rid of it. Typically, the Democrats don't like 100% bonus depreciation and the Republicans do. So it's just a matter of kind of what happens within Congress and what happens and whether or not any changes will be made. But like I said, right now through the end of the year, it's going to be 100% and then 80% next year. So I'll show you now kind of that same case study of that building for $1.3 million. What you'll see here is kind of a similar table, but what you'll notice is in the 15, 7, and 5 years, we're not depreciating those amounts over those years anymore. We're taking that the very first year in 2022. That's because that 100% bonus depreciation says that anything with a useful life of 20 years or less can now be expensed the very first year of the property. So we saw large benefits before when we were still doing it over the 5, 7, or 15 years. Now we basically supercharged the whole strategy. And rather than having $17,000 deduction in 2022, now the very first year we're coming up with $422,000 of depreciation deduction. So that's an increase of over $400,000. So really big incentive with the bonus depreciation to accelerate these deductions and reduce your tax liability. The catch-up benefit, like I mentioned before, you don't have to do cost segregation the year you bought the property. So if you've owned property for several years, the IRS allows you to kind of do a catch-up benefit, or what's called a Section 481A adjustment. Really, it allows us to go in and do a cost segregation study. We identify all that short life asset property and break it out. And then we say, okay, let's compare what you would have taken had you done cost segregation when you first bought the property, compare that to the straight line depreciation you've taken, and the difference there then can be caught up all in the current tax year. So you don't have to go back and amend. You actually get to catch that up as a 481A adjustment. There's just an additional tax form that gets provided called a Form 3115 that notifies the IRS that you're changing your depreciation method from straight line to the accelerated tables. So by going back and reviewing all that missed accelerated depreciation you could have taken from the time you bought, again, we can come up with a lot of deductions in the current tax year for you without having to have you go back and amend a tax return. So I'm going to show you a kind of a case study. This one looks a little bit different, but we're going to say that same example of $1.3 million being bought in 2015 instead of 2022. In that scenario, we would be saying that there was an additional $218,000 of deductions that could have been taken between 2015 and 2022. And so we're going to catch that up all in the current tax year. In this scenario where we're looking at it being purchased in 2015, there would be no bonus depreciation. So we would be doing the 5, 7, and 15-year assets over those timeframes. And so you would still get some deductions for those. Obviously, the 5 years already been fully depreciated at this point, but there would still be some for the 7 and 15-year assets. But by going back and doing a study on a property from 7 years ago, you'd be able to take $218,000 as a current deduction in the current tax year. So it's really good to go back. A lot of people have a misconception with this. A lot of CPAs have misconceptions with this, that, oh, you have to do cost segregation when you first buy a property. That's not true. You can always go back and do a catch-up study. It's really going to be based off of the rules that are in place in the year that you bought the property and put it in service. We've found benefits on properties going back over 10 years. So, it's always something that's good. If you've had a property for a while, reach out, say, hey, can you evaluate our property? We'll do a benefit analysis. We'll find out how much depreciation you've taken and what you could have taken, and see if it's going to make sense to do a study. So it's always great to get that analysis done, whether it's a new property, whether it's a property you've had for a long time, so that you can get the numbers and see, does it make sense? If it doesn't make sense, then no harm, no foul. Otherwise, if there is a benefit, then it's going to be great to take advantage of. As I mentioned before, a lot of people have misconceptions as well about what happens when they sell the property. A lot of people say, why will I do a cost segregation study if I'm just going to have to repay all of this back later when I sell the property? And it's a good question. And it's something that, again, is a big misconception. And there's a few things that to take in consideration with this. When you sell a property, there are going to be two types of taxes that you pay. You're going to pay a capital gains tax on the appreciation of that property. You're also going to pay recapture tax. But the recapture tax has a couple different aspects to it. And so we'll talk about that. But one is, a lot of times when you take the deductions from a cost segregation study, you're taking those against a higher income rate than the recapture tax rate. So for a lot of people, that's going to be around 40% ordinary income rate that they're using the deductions from the study against. When they do sell the property and pay recapture, the recapture is going to be at a lower rate of 25% for the real property. So that's a property that still stayed in the 27.5-year or 39-year category. So for that property, you would pay recapture tax at 25%. But if you paid deduction against 40, you've got a 15% savings there right away. And then there's that personal property that we broke out, that 5 and 7-year property. You don't really pay recapture tax on personal property unless you're selling that for a gain. So if you think about what personal property is that we typically find, we're talking about flooring, cabinetry, countertops, some lighting, those types of things. You're typically not selling for a gain when you sell a property. They may still have some value, but it's not as much when you bought the property. So by evaluating that, you can actually reduce the amount of recapture you pay on that personal property portion. And so what we typically see is that after a cost segregation study, you're actually still going to pay less taxes than if you had not done the study. And so that's something that, again, you need to kind of be aware of, because a lot of people think that you're just going to pay this all back when you sell a property. That's not the case. You're going to take all these tax savings now, increase your cash flow, be able to use that money to reinvest. And then when you do sell the property, you actually can reduce the amount of taxes that you pay at that time. So it's a good thing to be aware of. And we'd be happy to talk about that more if you would like to. Here's kind of a case study as an example for a sale of a property. Again, the slide's a little bit busy, but what I kind of want to highlight really is that the tax on this kind of, again, is on that $1.3 million case study that I did. And it assumes that we're now selling the property for a $2 million sales price. So really, we've got a gain of about $650,000 or so. And so without cost segregation, upon sale of that, the total tax of the capital gain and the recapture would be about $198,000. But after a cost segregation study and breaking that out and reducing the recapture, the total amount tax due would be $164,000. So about a difference of $34,000 as far as the tax liability upon the sale of the property. So hopefully that can kind of give you an example of how you can actually reduce the tax, even though you are paying some recapture. This slide here is really just kind of a summary of the things that I've talked about. One, just kind of the standard cost segregation study of how it typically designed, where we break things out and then do depreciate them over the 5, 7, and 15 years. In that scenario there, we would come up with an increase of about $38,000 on that one case study. If we factor in the bonus depreciation, that just completely jumped to a first-year depreciation deduction of $405,000. Again, then with a catch-up study, going back and say, what if we had bought that in 2015? Obviously, we get to increase that. As a current year deduction, we had about a catch-up of about $218,000, plus a couple extra thousand for the 7 and 15 year that were still being depreciated. So a total increase of about $220,000. And then again, the study for the sale of property, you could reduce, the tax gain on that case study by about $34,000. One of the things I mentioned before was some of the kind of side benefits that you kind of get with a cost segregation study. One of them that we talk about is partial asset dispositions. As I mentioned before, when we come in and do a study, we're going to identify kind of all of the components that we can within the property and put a cost to them. So we're looking at all those 5, 7, and 15-year assets I mentioned before that we're going to break out and move to shorter life categories. But one of the other things we're also going to do is we're going to put a cost to some of the things that still remain as 27.5 or 39-year property. We're going to put a cost to the roof. We're going to put a cost to the HVAC systems. We're going to put a cost to your electrical and your plumbing. By doing so, now that all of these things have been broken out to their own individual line item, rather than just land and building, which you would have if you didn't do cost segregation. Now that we've given you a revised depreciation schedule with the final report, and you have the cost of all your 5, 7, 15, and even your 27.5 and 39-year assets, then if down the road you decide, you know what, I need to rip out all the carpets, or I need to replace the HVAC system, you can then take an additional deduction in the year you make those improvements. So if you were to pull out your carpets in 3 years and get rid of them, if they were still being depreciated, your CPA would now know the exact cost of those carpets and then say, you know what, we're not going to continue to depreciate this stuff we're disposing of. You'd be able to take a deduction that year for that remaining amount, as well as any cost of having it removed. And then the cost of the new carpet would just be put in as a 5-year asset, and your CPA could do that. With bonus depreciation, a lot of the 5 and 7-year and 15-year things that we find, you're taking all of those deductions the first year. So now that bonus depreciation is in place, it doesn't typically apply to a lot of those things if you took bonus depreciation, but it still would apply to those larger structural or building things that still stayed as a building asset. So if you replace your HVAC systems, or if you replaced your roof, you would know the cost, and your CPA could say, okay, we still have $30,000 remaining to depreciate on that roof. We just replaced it. We're going to take that remaining $30,000 and just expense it in that year that you replace the roof. And so partial asset dispositions can be very huge and add additional benefits down the road as you make improvements to the properties. Here. So some questions to think about with cost segregation. What type of properties are worth looking into for cost segregation to take advantage of the current tax laws? It's pretty much any type of property. I know the audience here today is all a lot of apartment owners and stuff. They're great candidates for cost segregation, but we honestly do cost segregation on everything from single family rentals to multifamily apartments, office buildings, gas stations, ski resort, you name it. Anything that's being used for a business purpose can be evaluated for cost segregation. When does it make the most sense to do cost segregation study? Really, you can do it anytime. A lot of times, if you can use the deductions, it makes sense to do it the first year you bought the property. But maybe you have a lot of already deductions that have been built up and you don't necessarily need them. You can do it in future years when you do need those deductions. Like I said, we can go back and do a catch-up study with that 481A adjustment, and then allow you to take up those catch-up deductions in that current tax year that you need them. What items do you need to provide for cost segregation for a benefit analysis? Because as I mentioned, we will provide a free benefit analysis on any property that you've got. Typically, what we want to get if it's a new build, we'll want to get a copy of the closing statements or documents that show us the purchase price, the address, things like that. And then we'll kind of do some analysis by evaluating county records and other things we can online, and then provide a preliminary estimate. If it's something that you've owned for a couple years or more, we would want to get a copy of the depreciation schedule, because that would give us a breakout of what your CPA has put as an allocation to the land and the allocation for the building. It would give us the in-service date, and it would also tell us how much depreciation you've already taken. And that way we could compare that to what you could have actually taken with cost segregation. Typically, when we do a benefit analysis, once we receive these things, we will turn those benefit analysis around within about a day or two. So you can look at that. Along with that benefit analysis, we typically will provide an engagement letter that outlines our service, the things that are included in that, and what the costs will be. That way you've got everything you need to kind of determine whether or not it's going to make sense. You're going to know what the cost of the cost segregation study would be. You're going to know what the projected benefit would be. And then with that, then you'll be able to make a decision. You can even take that information and meet with your tax advisor and see, what their thoughts are and if it makes sense for you. There is a poll question that just popped up, and like I said, if you would like to or interested in a cost segregation analysis, you can go ahead and click yes. We'll get a list of all of that and can reach out to you to have those discussions. As I mentioned before as well, I've got some contact information here and that we can provide you. Alexandra is going to be sending out a copy of the presentation and these slides, and you can feel free to email me, and you can feel free to use this QR code here and just scan that, and that'll take you to a short inquiry form where we'll gather your information. And at that point, we can give you a call and talk to you about what properties you've got, what situations you've got, or if you just have questions, we can certainly answer those questions as well. We have kind of gone through the presentation a little bit quickly since we've got a large group, but I'd be happy to try and answer any questions for a while if people got those, because I know I went through a lot of information. So we'll Alexander, you want to try and open it up a little bit?
Yeah, absolutely. We have plenty of questions in already, but certainly if you still have questions or you think of any, please put them in the Q&A box, not the chat. So one thing that I saw that came up quite a few times, and I think you answered it at the end, is that the cost segregation can be used for single family rental homes as well, not just apartments. Someone else asked if that would also be okay under the 179D, 45L, all the other strategies that you talked about. Do those all apply as well to single family condos or townhouses?
Yeah, so the 45L tax credit is meant for residential properties. So it does apply to anything from single family to multifamily and apartments, up to apartment buildings that are 3 stories. If an apartment building is over 3 stories, then we would need to look at the 179D deduction for those. And then that 179D deduction is typically mainly for commercial properties, except for, apartment buildings that are 4 stories or more.
Okay, perfect. So that answers quite a few of the questions that were kind of repeated there. So another question that came up a couple times was, is bonus depreciation recaptured on sale? And I think you mentioned this is like a common misconception as well. So maybe just some clarification on that might help.
Yeah, so as I mentioned, really the bonus depreciation, there is recapture on that when you do sell the property. So if you do a cost segregation study, whether or not bonus applies or whether or not we just accelerate it over the 5, 7, and 15 years, there still would be recapture. There still would be recapture tax on that accelerated depreciation taken. And so what I mentioned though is that with recapture, there are kind of a couple things to keep in mind. One, you're typically taking these deductions from the cost segregation study at against a higher ordinary income rate. Typically, a lot of people are in that 35 to 40% tax bracket. And so you're taking all of these deductions against that higher tax bracket. And then when you do have to pay that recapture, the portion that is real property, so that 27.5-year asset, 39-year asset property, which is still usually about 75% of the cost, that would be repaid at a recapture rate of 25%. So you're paying it back at 50% less rate than what you actually took it against. And then the personal property that we broke out is treated differently for recapture purposes. It's taxed at ordinary income rates, but you only pay the recapture on that personal property if you're selling it for a gain. And so a lot of those things that are considered personal property, like carpets, countertops, cabinetry, things like that, they're going to go down in value after they've been used. You're not going to sell them for a gain. And so typically you're going to reduce the recapture on that portion. And so that's kind of where I went through that little bit of a sale analysis that kind of showed you, even though you're going to pay recapture, you're most likely going to pay less tax upon that sale because of that less recapture on the personal property portion.
Okay, that was a great summary. Another couple questions about cost segregation. Ellie asking about a hot water tank. Does that qualify for cost segregation?
A hot water tank is going to be considered, still, it's going to stay in this 27.5 or 39-year category. The law basically says, with every building, it's going to be kind of considered part of the building. You got to have windows, you got to have doors, you got to have HVAC, you got to have your hot water. Those are going to stay as real property and aren't going to be moved to a short life asset.
Okay, Tina asking, are the costs in the cost segregation study based on what we actually paid? So would we have to have the receipts?
Yeah, that's a great question. The cost segregation study would be based off of actual costs. So we look at the costs for the purchase of the property, the cost of any improvements made to the properties. Those are what get evaluated and are eligible to be depreciated. So it's not something that you can do a bunch of improvements, get it reappraised and say, hey, it appraises now for 500,000 more than what we paid. Can we depreciate that? No, the IRS only allows you to depreciate the actual costs that you're incurring.
Great. And I know you had a slide that had some examples, but Sheila's asking if you have a more comprehensive checklist of the items that could be used for cost segregation.
That's kind of our quick summary checklist. I can see if we could provide something more. But like I said, there's kind of the 3 tests that apply. Those are typically the things that we're finding, though. There are unique things with every building, but when we're talking about residential type properties, that's a pretty good list of the things that we're going to identify.
Right. And also a question about, well, lots of people asking about the recording. So we will be sending the recording tomorrow to everyone. So don't worry about that. Kevin asking, do deductions carry forward to future years if they are not needed in year 1?
That's a great question. Yes, they do. So if you're not able, like I said, when we do bonus depreciation, we're coming up with quite a bit that very first year. So if you're not able to take advantage of all of that, anything that's not used is automatically going to carry forward to the next year. You don't lose any of that.
Great. Kevin also asking, does the 170D tax deduction count for a 2-story multifamily residential building?
Not right now. You would want to look at the 45L. Starting in 2023, the way the legislation is written right now, it sounds like you may be able to take 45L and 179D on those, but we're waiting further clarification on that. But right now, for residential, it's mainly the 45L tax credit, unless it's a 4-story or more apartment building.
Great. And Mauricio is asking, is the 45L a one-time only credit?
Yes, it's one-time only credit that you can take. You don't get to take it each year. So it's either when the property's first built or first renovated. That's when you would take it. Like I said, you can go back with the 45L study and do properties that were back as far as 2019. You would just need to amend the returns, but you can only take it one time.
Okay. Yeah, and Adriana was asking, I think you might have just answered this though, how far back does the 481 adjustment allow on the property?
The 481A adjustment applies to the 179D because it is a tax deduction and not a credit. And so we can go back further on that one, just like we do with the cost segregation studies. Since they're deductions, we can go back and calculate all of them and then actually catch them up in the current tax year without having to amend. So that's kind of the nice thing about the 179D. It's unfortunate that with 45L, you have to amend, but it is different because it's a credit, not a deduction. So with the 179D, we can go back over 10 years and do an evaluation.
That's fantastic. Okay, Sarah asking, if our tenant pays the utilities, how would we determine if there is a 50% savings on energy?
Yeah, we wouldn't really be looking at the utility bills and things like that. What we would be looking at is the improvements that have been made to the property and comparing them to standards that have been created for each year to kind of model against. And so what we would be looking at is, what R value insulation did you put in the walls? What R value insulation did you put in the ceiling? What U factor is the windows? What is the model and make of the HVAC, the AC, the water heater that you put in? We take those things, and look at the layout of the property and run it through a modeling thing that will tell us with those components and their efficiency levels, where does that put us in relation to the standard they want us to beat. And so those were the things we would look at to make that determination.
Okay.
Both with 179D and with 45L.
Great. And that is where your services, come in handy. And that's why I guess you go to the property, right? To see all those things as well. So a couple of people were asking if they do want to use your services to do one of these studies, what is the cost, or how do you determine the cost?
Yeah, so we typically are determining the cost based off of the amount of work that's going to be involved. It's going to depend obviously on the size of the property typically, when it comes to cost segregation, and as well as 179D. Our prices kind of start for single families right around 2,200 and then move up, just depending on the size of the property. For the 45L studies, just depending on how many we're doing, the cost of those typically ranges from about $300 to $400 per property.
Okay,
and then
not
when
bad.
we provide a benefit analysis, so that you have all the information you need, we'll run that benefit analysis that shows the projected deductions, increase in deductions and savings, and we'll give you a cost at that time for your specific property so that you know what it's going to cost and what the benefit's going to be.
Yeah, that is really nice. So, for those of you that did say yes to the poll or at registration, or even when you exit this webinar, there will be a survey and it'll have that question yet again. So you can have multiple opportunities to opt into that, because I think that makes a lot of sense to just know whether it's worth it before you start doing something like that. Okay, also asking here, Alan is asking, is bonus depreciation the same as section 179 deduction?
It's slightly different than 179. So 179 provides clarifications on things that can be kind of expensed in the first year and things like that. But it is different than 179.
Great.
With 170, the things that qualify with 179, and that's kind of a whole nother topic, but there are certain things that can be taken as and just fully expensed in the first year. So if you're making small improvements and small things like that, a lot of times those could be fully expensed.
Great. Mitra asking, is your service deductible?
Yes, the cost of the studies is actually can be written off as a deduction as well. So
nice.
You basically take that as a deduction in the year that you pay for the study.
Great. And Kevin, different Kevin, asking, how long does it take to perform a cost segregation study?
Typically, it's about a 5 to 6 week process to get it completed. We usually will gather some information up front, get you that benefit analysis, and then once we're engaged to do that, we'll look to schedule a site visit of the property. For larger properties, we'll actually have someone come out and visit in site. For single family homes or small multifamily homes, sometimes we can do those through a recorded video conference to kind of reduce the out-of-pocket costs. We don't have to have someone travel there. But really, once we have actually then visited the property and seen it, typically we're going to get the final report wrapped up within 2 to 3 weeks.
Great.
And then, Alexander, I think I have time for one more question. I've got someone that's going to kick me out of my conference room.
Oh, no. I wonder if there's a way you could still join in with us on another account, perhaps, because we'd love to have you stay and answer some more questions. But I definitely understand. We have about like 22 questions left, so that's
Okay.
a lot. Let's see. Well, the other thing we could do is email everyone after we get off of this. Your team could follow up with them. So if any of you have answered a question or asked a question, we have your email address attached to the question, so we could email you an answer. What do you want to do, Jared?
Yeah, I think that would be great. If you have those questions, what we can do is respond to each one that submitted that question. I think that would be great to get back in touch with them and answer their question individually.
Okay, perfect. Well, this was really helpful. Again, the recording will be emailed to everyone tomorrow along with the slides, and we'll also give you Jared's information, which is on the screen. And if you did say yes, that you want a complimentary cost benefit analysis here of this, any of these strategies that we've talked to about today, then the team at Cost Segregation Authority will be getting back to you probably within the next couple of business days. I imagine there's a lot of you who requested it, but they will be prioritizing anyone who did want something like that set up. Also, when you exit the webinar, please take the exit survey. I'd love to hear your thoughts on this webinar, suggestions for future webinars, and also, any sort of ideas or comments you have as to how we could improve the whole process. We are booking webinars next year, so I am looking at those comments and determining what topics we should be covering in 2023. So Jared, thank you so much for your time. I really appreciate it. This was super informative and helpful, and I think everyone on the call learned something new today.
Thank you very much for having me. It was great to do, and I look forward to answering all the questions we couldn't. So sorry we ran out of time, but again, thanks for having us, and we look forward to talking with everyone.
All right, everyone, have a wonderful day. Bye-bye.